now invite Rajeev to talk about investing in India from a practitioner's view.
All right, I'm back on the podium with a different presentation this time. So what I will do this time is talk a little bit about investing in India from a practitioner's perspective. Right? As Shuchi mentioned, I run this fund, DoorDarshi India Fund, and so this time, rather than talking about India, I'll be talking about the fund. Again, a disclaimer, and this time at the fund level. So I'm going to talk about historical returns. It doesn't mean that I am projecting those future returns will be the same, right? I think that's the key message. There are a lot of other things. We are not trying to sell you anything. We are only trying to make you aware of what is possible. And I want to ensure that I keep highlighting this because I don't want any confusion around that. Again, we are not trying to sell anything. If you were to sell anything, you will do it separately. Okay, so with that, let's move on to the agenda. I'll talk a little bit of my background, more from an investment journey perspective, and then talk about the fund, what we have done in the fund, how has the performance been, what we think, why we have been able to do reasonably well, our investment approach, and then we will summarize what I have to say to you today. So let me talk about my investment journey a little bit. It started in 2016. That is when I decided to move out of the corporate world. I was in the corporate world for almost 2 decades. And at that point I said, okay, I'm done enough with the corporate. I had a situation where I felt like, okay, I'm financially independent. And then I said, okay, I will become a full-time investor. And the typical Hollywood profile of a full-time investor is sitting on a beach, sipping margaritas and chilling out, right? And this is 2016. And of course we had Brexit. So once Brexit happened, a lot of people were concerned that the stock market fell a lot. And this is all good from an overall historical perspective. But I think for us, it was reasonably good time. 2016 is when I started. And in general, the personal portfolio did reasonably well. And over time, people would say, listen, how can I invest with you? Or how could you invest for us? And we did not have a vehicle so that people could invest with us. But in 2021, I set up this vehicle, which is DoorDarshi India Fund, which we'll talk about. And you can see me, again, a lot of these images, by the way, are generated by ChatGPT. So you should realize that ChatGPT does a good job because you can see I'm googly-eyed there, right, when starting the fund, which is good. So I started the fund in DoorDarshi India Fund. And last year, my son was asking me, listen, Papa, you have been doing this fund for a long time. What is next? And I said, what is next is just running the fund continuously as long as I can do that, right? So you can see me in 2025 very happily running my hedge fund, right? So that's sort of my investment journey. But really, since a full-time investor in 2016, I have been also presenting on SumZero. SumZero is a platform where you can post your research, and I'm a top-ranked analyst on SumZero, where I have been pretty much in that period between 2017 and 2025. I have been ranked in the top 5. So I'm currently ranked number 1 in financials across maybe like 15,000 plus analysts on SumZero. I'm also ranked number 1 in the special situations category, again, across all the analysts in the world on SumZero. I'm also ranked number 3 across all categories on SumZero. So I think that has been a very good journey in terms of proving to myself, frankly, not to anybody else, that the research that we do is good quality research. A little bit about the corporate journey. So we did talk about, I worked at Goldman Sachs, Bank of America, JP Morgan, and S&P Global. So that was around 2 decades of doing that. In these various Wall Street firms, I was on the risk management side, where I was either managing risk for the firm or managing risk in the prime brokerage division, which is Goldman Sachs, Bank of America, JP Morgan. And then I retired from S&P Global as a managing director at S&P Global. And then education-wise, IIT Bombay, IIM Calcutta, and CFA. So actually my investment journey, frankly, started way before what I put out here. So my investment journey started because I knew way back when I was in school, my grandfather used to invest in the stocks. And I found it fascinating that he would read newspapers and he will invest in IPO. And I'm like, okay, that is very interesting. You can read a newspaper and you can decide. So when I went to IIT Bombay, I said, okay, now I know all about investing, so let me start investing. And that was the time when India was going through a huge bull market. And this is the 1991 bull market, for people who know that. And of course, 1992, the whole stock market came crashing down, and along with that, my aspirations of becoming a stock market investor. So I went to IIT Bombay in 91, and so in 92, I said, okay, now, my studies are done, let me focus on the stock market, and I realized I don't know anything about the stock market, right? So whatever money I took from my father to invest in the stock market became zero, and then I said I will never touch stock market, right? So that is, having that journey where you go through a period where you have really been hurt so badly, and for the next 10 years I did not touch stock market. So I skipped the whole 2000 crisis which happened in the stock market. But that's sort of the investment journey. And then a little bit about the fund. So the fund is a US domiciled hedge fund. So obviously we are subject to the US regulations. And the fund is also registered as a foreign portfolio investor into India. And that allows us to then benefit from the stock market opportunities that I talked about earlier in my presentation. So because of that, we have access to all the Indian equities that one could invest in. And what our goal is to deliver strong returns over time. We tell people we cannot do strong returns on a 6 month, 1 year basis, but if you think 3 to 5 years, that's really where we are trying to do well. So if that is what we are trying to do, how have we delivered? So these are our historical returns. So the fund was started in 2021 April, and from 2021 April till 2024 are the terms that I'm showing you here. So let's start with the bottom. Ultimately, we should all start with the bottom line. So let's start with the bottom line of the table, which is the CAGR. So the fund has delivered around 25.8% dollar returns, as compared to S&P 500, which has delivered a 12.7% dollar returns, obviously. Nifty 50, again in dollar terms, is 10.2%, and MSCI India is 11%. So I think it is fair to say that the fund has done far better than all these indices. And the reason I want to put this slide is to tell, when I talk to many people, they say, oh, S&P 500 has been on a tear. And it has been on a tear in 23 and 24. But look at what happened in 22, right? The 18% down, which happened in 22, obviously brought down the overall returns of S&P 500 from 20s for the 3 years that you see, 23, 24, and 21. But in 2022, because it had an 18% drawdown, its net return has been 12%, right, over the period that the fund has delivered, that the fund has been in existence. In the same period, fund has not had any down year. That's great, and therefore we had one banner year, which is 2023, where we did very well. So when I present this, a lot of questions come around what happened in 23, and the answer is nothing. Nothing happened. We were all along investing in a similar manner, and what did happen is that in 2023 the market recognized the undervalued companies that we were holding, right? So we don't know when that undervaluation will get resolved, but it does get resolved over time. And really, after the year 2023, one of my focus was we want to ensure that we preserve those gains, and 24 has been a reasonable year for us. You can also look at how Nifty 50 has done, and Nifty 50 is again, you can see that both Nifty 50 and MSCI India, which are typically the other benchmarks that people compare to for an India-focused fund, you can see that it has not been, it has delivered reasonably good returns, but still it is a little bit trailing behind S&P 500. A few caveats here. Obviously, I've said past performance does not guarantee future results, so please don't assume this is what we are going to do in the future. The returns have been audited. Everything that I'm presenting here are audited by our auditor, which is Spicer Jeffries. Now, importantly here, many times people think this is the gross return. No, these are net returns. These are returns for the investors, for the limited partners after fees, expenses, and Indian taxes, right? So this is after accounting for all the various expenses that are allocated out to everybody. And then for S&P 500, Nifty 50, and MSCI India, these returns are in dollars, obviously, and they are total returns, which includes the dividends. This is another way of reflecting how the fund has done. So $100 invested in April 21 has become to $37 versus between 140 to 160 for the various indices. One more thing, I said the fund audited returns are 25.8% or 137% total returns. But for most investors, and almost all the investors in the fund are investing from the taxable account. And when they're investing from the taxable account, then because the audited returns reduce the returns which have been because of the taxes that we have paid in India. So therefore it is important to also compare the other returns, which are the fund returns before taxes in India, right? Because a person in the US investing from a taxable account will get that offset for the taxes paid in India. And therefore their returns should be ideally the economic returns are the fund returns before taxes. And therefore the fund returns before taxes is actually around 2% additional, which is 27.9% CAGR, and which is a 152% total. And this is the economic returns for all investors. In our fund right now, everybody is investing from the taxable account, and they are benefiting from the credit. I don't know of anybody who is not. And so this is the real economic returns that our investors are having. Okay, so I present this, and then obviously the next question is, why do you succeed? What is it that you are doing that allows you to deliver so much better returns than the index, when we know that beating an index itself is a challenge, right? So first, we succeed over the long term, as we have always said. We don't know what will happen in the short term, and we are not trying to optimize for that. But why we succeed is because we focus on what matters. And what we focus on first is knowing who we are, and therefore defining what our investment philosophy is. And our investment philosophy is to buy good companies at good prices and ensure that we have good management. I think the third bit, good management, is very, very important in the Indian context, because even if it is a good company, but the management is not incentivized, or they don't have the drive to actually create good returns, then you will not see as good returns. So the management incentive, it becomes very important. Once you have the philosophy, which is fundamental based investing, finding good opportunities, then it is about how do you go about doing that. And that is the investment process. And when you're looking at the investment process, you have to figure out what opportunities do you let into your process, how do you filter those opportunities, and then figure out where you invest. And this is where the discipline comes in, because if you don't have the discipline, market every day is giving you new opportunities. And so you have to decide where you will go and how you will invest. And of course, that leads to the portfolio. So that is what we focus on. Equally important, it is to figure out what not to focus on. So I think many times we have heard Charlie Munger talk about it, that ignoring what doesn't matter is more important, right? Rejecting things which are not good is more important, because that's easier to do. And many times even in this conference, I've been asked, listen, how much money do you manage? And I always tell them, listen, we don't talk about how much AUM we manage. And the reason for that is very simple. We don't want to focus on it, because we think it's a vanity factor. It's not an important factor. What is important is to focus on the returns, and AUM and everything else is a subsequent consideration. So we don't focus on things which will make us look good, but which we think will not help us deliver good returns over the long term. So that is AUM, I already said. We are not focused on AUM. I think if we deliver good returns, AUM will come, and we will talk about what are the type of investors. So I think that is another very important factor that I will talk about. But the other thing we do not worry about is volatility. In the whole investing world, everybody thinks volatility is the way to look at investing, and to understand how the risk is. We think volatility, from our context, is the source of opportunity. We always think if things are volatile, if we have done our own analysis and we can understand how the companies will do, we feel that we can take a benefit of that volatility, invest when the markets have gone down, when your stocks have gone down, and sell when it has been the reverse. We also do not go into fads. And again, different fads develop at different times. But if we do not understand the fad, for example, AI, or for example, in India, there was a big fad that was going on around renewable energy. So we own one renewable energy company, but there was a big fad around the renewable energy, or the e-commerce companies, or the fast delivery, all of that. If we do not understand the economics of that, we are not going to invest in it. That may cause us to miss out on the upside, but it will also prevent us from suffering on the downside. And we think not suffering on the downside allows us to have an approach that I've laid out on the left-hand side. And then the fourth thing that I have mentioned here is diversification. So we are happy to diversify when we have multiple opportunities with similar risk and similar reward. But most of the time that happens. Occasionally, you might have one opportunity that has a much better risk reward. And when that happens, we are not in the business of diversifying. We are in the business of concentrating. We want to concentrate when we find good opportunities. It's rare, and that is what, again, a lot of things that I'm talking about, we have learned from Buffett and Munger. So it's perfect that we are talking about in Omaha, because that is where we have learned this and we are trying to practice it. And I think it's a great way to give back to the people who would want to listen, but it is also a good way to re-emphasize to myself of what matters. So we will diversify if there are multiple such opportunities which have a similar risk reward. But if not, if one opportunity looks very interesting to us, we are happy to concentrate. That's sort of how we look at it. Okay, so the other bit why we succeed is because we have the right investors. And I think it's so critical, because what happens is when there's volatility, the first thing that happens is people say, oh, why is it down? Well, nobody really knows. I can come up with a good explanation, but that doesn't tell you anything. So what we want is investors who can think long term. If they can think long term, and I will tell you, I showed that we started in 2021. 2022 was a pretty bad year for all the fund managers, right? But we never got even one call in 2022 saying what is happening with the fund. And even though we were positive for the year, there was a first half, we were not positive, we were negative, right? And so the beauty of having that approach of choosing the right investors allows us to ignore the noise, which is the volatility, which is where you are not really understanding why things are happening, and really use that opportunity, the volatility, to deliver good returns. The second thing, again, so I will tell you a story. Buffett talks about, Buffett has said we can invest in a stock very quickly. So somebody asked him, listen, how can you invest so quickly? How can you research a stock so quickly? And his answer was, price is intelligence, right? So having the right price allows me, even if I don't know enough, to be able to buy a company. And that is what we always are trying to do, buy companies at the right price. Because if you buy at the right price, when you're buying, obviously you want the lower price as the right price. So when you're buying at the right price, you have two things going for you. You have high return expectations because the price is really compressed, and the risk also has gone down because you have a low downside. So we want to have right investors, right price, and then we want to have right record. And this is two-part. One is the right track record that we have, because that gives us the confidence to be able to pursue the approach that we are using. And we also want to have a right track record of the companies and the management that we are investing in. Because if the track record is good, that gives us the confidence to know that even if there is a small downside that has happened, I think it will do all right because the management is well aligned, right? And similarly, on the companies, if the business is good, many times any downfall are opportunities that the company are able to benefit from. So those are some of the factors that I would say has enabled us to do well. Now I say, okay, listen, this means that, and so all the questions or all the slides I put is where I get a question from a person. So when I show those returns and show this, people say, oh, are you a one stock wonder? Like, is there one stock that has done well for you and therefore you have these good returns? So in 2023, end of 2023, in my annual meeting with my investors in 2024, I presented this slide and I'm reusing it. So this is not the latest because I did not do the latest analysis. But at the end of 2023, we had at that point I had owned, either way, I mean I might have sold some of them, but I had owned ultimately a total of 29 stocks, of which I had sold 8 stocks in that 3-year period from 21 to 23, right? Of those 29 stocks, 20 of them had delivered IRR of more than 25%. 15 of them had delivered IRR more than 50%. Now, that was also because 2023 was a good market. So I'm not taking full credit for it, but what I'm trying to say is, I think that was a good market, but we did very well. But the flip side also is that we did not lose a lot of money. Only 3 out of the 29 stocks had poor outcomes of the 29 that we owned. So this was the IRR distribution that it presented in 2024 for our portfolio from 21 to 23. And you can see that this is the type of distribution all of us would love to have. So I'm very happy with the distribution, which is less than minus 10%, 3 stocks out of the 29. I call it break even, minus 10 to 10% is like 4 stocks, and then rest of them were doing much better for us, right? And so I think this illustrates what approach we have talked about, and it helps us sort of reconfirm to ourselves, frankly, that I think what we are doing makes a lot of sense. Now, most people say market is efficient. I always try to remind myself, but then also anybody I'm talking to, that market is not always efficient. But more importantly, individual stocks are even less efficient because markets reflect the average. Because markets reflect the average, but individual stocks actually move around a lot more. And so whenever you see volatility, I think this is something to always keep in mind, right? And this is just a normal day at the nation's most important financial institution. Here we have an investor, trader, broker, whatever. He says, I have got a stock that could really excel, and that excel becomes a sell, and everybody's selling, and then somebody says this, and this is madness, I can't take it anymore, goodbye, and that goodbye becomes a buy. So I think if your portfolio is going through a lot of volatility, if you have done your work, I think you can keep this cartoon in mind and hopefully go through that. Now, what is our investment approach? I talked about our returns. So here are a few investment tenets that we follow as we invest. The first thing is expected return framework. And so whenever we are looking at any opportunity, and the problem with stock market, which is also a huge advantage with the stock market, is there are many stocks. If I'm looking at Indian stock market, there are almost 5,000 stocks, more than 5,000 stocks that are listed. How do you quickly drill down that opportunity set into a much smaller set? And so what we use is this expected return framework. And what we are basically saying is, given the current price, given our expected price, what is the return expectations? And then we will force rank all our opportunity set by the return expectations. So that is how we reduce the wide universe into a much smaller subset, because first of all, we cannot even evaluate most of the companies. We don't even understand the business model, like how I was talking. And if I do not understand the business model, I cannot value them. If I cannot value them, I cannot have any return expectations. So that way, a lot of those fad companies that we don't understand, automatically fall off our radar. But of those that we understand, we then follow this expected return framework. The second one is management quality, and I think this is critical. In India, if there's one thing that I would say that one should do more, like Buffett always says, first is business, then is management, then is price. I would say in India, you need to have first as management. Management is absolutely critical. If management, you cannot be comfortable, you should not be investing. Because unlike in the US, where you can have activism, in India you do not have activism. So there is no point in trying to be an activist investor in India, because you will go nowhere, right? So if you cannot trust the manager, if you cannot be confident about the manager, you should not invest. And I think this quote, can't do a good deal with a bad management, is really critical. Circle of competence, I already said. If you don't understand the business, it's not in your circle of competence, don't even bother about it. I think this is a Buffett concept. I just take it a little bit further and say that even though we don't understand, I'm always trying to understand, because this is how you build out the circle of competence. And Buffett has never said how he has built out the circle of competence, but the only way to build it out is continuing to look at new opportunities, assess them, and then say whether you understand enough. Even if you don't understand, there is no harm in trying to continue to learn about competency or understanding new businesses. Long-term orientation, I think, is critical. We are not a short-term investor. We in fact encourage our investors, if they're short-term, not to join us, because we think in short-term it's very, very hard to make money. We don't know how to make money, right? And so we tell our investors up front, if you can think a few years out is when you should be investing, and that is how we invest. So for example, if I look at our portfolio, our turnover rate is less than 20%. So in fact, we have holding period of around 5 years plus, right? So that reflects the long-term orientation. And then we ignore the investment dogma. I already talked about it. What we ignore: volatility, diversification, benchmarks. So while I did compare the benchmarks, we are not looking at the benchmarks at all when we are making investment decisions. We are only comparing those benchmarks because those are the benchmarks other investors use in terms of the alternatives. And so that is why we are giving those benchmarks, but we don't look at the benchmarks, either Indian or US, because in US anyway there's no overlap, but Indian benchmarks also we do not look at, and I already talked about the AU. Portfolio allocation, so I already mentioned we like to concentrate, but this is our approach, which is, first of all, stock returns have a power law distribution, as we all understand. And power law distribution means only a few companies will deliver the best returns, and most of them will give a very mediocre returns. And that is how we concentrate our portfolio. So a few stocks will have a much higher concentration, and then we will have a long tail of opportunities that we are either trying to understand or we are trying to build, right? Either in terms of increasing the position or reducing the position. Compare this, and then we also do the force ranking, which is the opportunity cost. So whenever we are buying a company, we are trying to assess, okay, if you're buying this company, what is the next company we could buy, right? And that helps us decide what is the best opportunity we have. Again, this is among the concept that all decisions should be based on opportunity cost, or what could be the next thing that you can buy. And that is what has allowed us to deliver the returns that we have. Risk management, I think we talk a lot about portfolio selection, but don't talk enough about risk management, how do you manage risk. I think for us, I said, do we understand the business? That automatically removes a lot of the businesses. And if we do not understand a business, doesn't mean we will not try to understand, but we want to ensure that only big positions are with businesses we feel good about in terms of our understanding. The second thing is past track record, and this is the track record of the company and the management we are investing in. Because I think past does not necessarily predict the future, but it rhymes. And so if we know that the company has delivered well, and so we almost never invest in IPO company because we do not have enough track record, and we want to see track record. So that is the best demonstration of how we think about the track record, is we will invest only in companies where we have seen how they have behaved over different time periods. If you can see how they behaved during COVID, it will tell us a lot about how they think. Then we want to see whether what they are saying and what they're doing, do they match. Talking is easy. Delivering is very, very hard, right? And so we want to see whether the talk is being backed by the actions. And that's where the past track record comes in. Management incentive is a critical factor. Now this is where actually Indian stocks are a little bit easier, because most of the managers typically also own the company. And so they have the incentive to do well by ensuring that the business does well. And so the management incentives are quite aligned, and I think that that's one big benefit of investing in Indian stocks. Capital structure. We like capital structure of companies to be not highly debt oriented. We want them to have enough ability to benefit from the issues that we will see in the market from time to time. So we want low leverage. We want them to be able to benefit if there is an exigency out there. And so low leverage, enough capital adequacy in case of financials. So one of the questions that I was asked is, listen, what sectors look good to you? One of the sectors that we have found quite useful for us in the last 4 years in India has been financials. And when I look at the financials, I personally think financials will continue to do well because the credit opportunity in India is huge. Even now, the bottom of the pyramid, a very small portion of that bottom of the pyramid has had the opportunity to be able to get credit. And to that extent, we think that is one sector which will continue to do well. Compelling valuation. I think ultimately price is most important. Price versus value, not price by its own definition, but what is the value of the company and how much is the differential between the value and the price. The bigger the differential, better the returns, lower the risk. And so we like compelling valuation. And then lastly, position sizing. I think it's not talked about enough, but position sizing is critical. You know, a stock that doubles for you, but you don't have a very small portion doesn't give you much returns. So where you have the conviction, where you see the upside, if you position size it accordingly, you can do much better. And so position sizing, and when we don't understand a company, having a smaller position is equally important, right? So understanding what are the risks, what are the rewards, and then position sizing that is very important. And all of that then drives the portfolio creations that we have. So with that, let me conclude a few things. We think Indian equities are likely to be among the best performing asset class in the world, as they have been in the past. And I showed that in the previous presentation that they did really well. India actually is a stock pickers market. While a lot of other markets have become much more correlated with everything else, we feel that India is still a stock pickers market. I showed you my returns. You can look at many other people's returns, and you will see that there are many fund managers who can do better than the stock indices, unlike in the US where it's a lot harder. And so that tells you that India is a stock pickers market. Another thing that tells you that if you look at the passive ETFs that are listed in the US, you will realize that most of them have not done well. Because the ETFs that are listed in the US, they typically are investing based on the index composition. They're not doing a lot of active investing, and therefore they have not been able to deliver as well. Now the fund in our mind is very well placed because we think that we are able to give this opportunity to global investors to benefit from the opportunities that we are seeing in India. And that has been demonstrated through a track record like how I was saying. We have delivered a 26% CAGR for LPs versus a 13% by S&P 500 and 11% by MSCI India. US investors also benefit from the low correlation, so I did not talk about it. But if I look at the fund performance, monthly return performance vis-a-vis S&P 500, the correlation is only 18%. So you have a good asset class with a low correlation. That's nirvana. Right? If you can deliver good returns and not have the high correlation, and so that everything moves together, that is what one should have. And the fund so far has had much lower correlation at 18%. Again, I'm not predicting this is what will continue, but I think it is, even if it goes up some, I think the correlation is relatively low. Alignment of interest, I was talking about alignment of interest. I am the biggest investor in the fund, and I love that because I want to ensure that if the fund does well, I benefit from it. And there is nothing like, when the fund does well and you feel like, okay, fine, I'm benefiting, I'm the one who's benefiting the most, right? So I'm the biggest individual investor in the fund, and I think that's a great way for me to compound my wealth. And then we think our aspiration is to do a 2x in the next 5 years, which will mean a 15% plus CAGR. Obviously, we have a track record of that, but if we can deliver that, that will be more than 50% better than what S&P 500 has done historically, which is around 10%. So overall, we feel very good about past track record, but also about the prospects of what we are seeing in the future. I will stop here and see if there are any questions.
Thank you, Rajeev, for the presentation. This is Vikram Jaiswal from Fremont, California. I had one question. What are the options to invest in this fund with retirement account like 401k and IRA? So both work slightly differently. Sometimes 401ks, you have only a fixed number of investments. IRA, you have more options where to invest.
Yeah, so we have option through an IRA account where we have a tie-up with one of the IRA agencies, and so you can invest through them, and through that one could invest into the fund. So yes, there are options of investing not through 401k but through IRA for a non-taxable use.
And what are the pros and cons of investing in retirement funds versus your after-tax money?
Yeah, so what happens is the fund has to pay taxes in India for all the investors, right? And whatever taxes we pay, they get allocated out to the investors who invested in the fund. If you're investing from a taxable account, then when we give out the K1s, which is the annual statement which shows your capital gains, your dividends, and the taxes you have paid as an investor into the fund or to the Indian authorities, you can possibly get credit for that in the US. Right? So in the taxable account, you will be able to get credit for the taxes that the fund has paid in India on your behalf. If you invest from a non-taxable account, maybe you can keep the record for 20 years and then benefit from it, but it just makes it a little harder for you to track the taxes and benefit from them. So that is an advantage versus a disadvantage, but otherwise, everything else is the same. If you're thinking from a long-term perspective, I would say either is fine, but you just benefit a little bit. And I showed you the difference, right? 25.8% for non-taxable account, and around 27.9% for taxable account, non-taxable account. Okay, basically 25.8 for non-taxable account and 27.9 for taxable account. Correct. Thank you.
Okay. Yeah, one more question.
Yeah.
So, like, how does this work if you compare it with the regular mutual funds, which have a price for every day, right? So, how does this fund
Yeah. So the fund, one can invest only once a month, which is end of the month. And in terms of if you want to withdraw, you need to give us 45 days notice. But the fund does not have a lock-in. Unlike most of the funds, we don't believe in lock-in. What we do is we tell our investors, please do your diligence. Once you come to us, you should be planning to stay with us for a few years. But suppose tomorrow you have an emergency, then I want you to take your money and do whatever you want with it. So we don't believe in having a lock-in. But we do ask our people, our investors, to give us a notice so that we can sell without having a forced sell.
One more question. You said that this is a hedge fund.
Yes.
So the restrictions are different, right? Do you need to be accredited investor to invest in it, or like small investors can also?
No. So this is only for accredited investors, we only accept accredited investors, and it's a hedge fund.
Thank you.
Sure.
Thanks, Rajeev. This has been a great event and presentation. I appreciate you touching on at the end there around position sizing. I don't think that's talked about as much, from the investor active managers. And I'm curious, as we're trying to avoid permanent, impairment in capital, if you find a compelling investment that's a home run that meets your tenants, what is an initial position size that you're comfortable with taking, and how do you think about that more?
Yeah, sure. So what happens is, at least for me, what I have found is I don't have a lot of conviction on day one, right? Conviction comes over time as you learn about the business, about the management, and as the position either performs or does not perform, but you have done more work. So what I have found is if I have tracked the business for a long time, and suppose it was very expensive and I did not want to buy, but suddenly it becomes very compelling, I am happy to buy a meaningful position, and that could be a 5 to 10% position of the fund, assuming I have that much cash available. Suppose I don't have the cash available, I'm happy to start selling, and I might even go beyond 10%. So in our fund, we don't restrict ourselves. The only thing we say is there is a soft limit of 20% and a hard limit of 30%, which means that beyond 20% we are unlikely to buy, though we can. 20% of the AUM I'm talking about, right? But we will never let a position go beyond 30% of the funding. So that is our absolute hard limit. We'll never let that. Right now, when I look at the fund, the top 3 positions would be around 30 to 35% in aggregate. So the biggest position would be like 12%. But that's how we think of it.
That's really helpful. And then just quickly on that last part, if a position does get to 30% or so, and you still like the company and the prospects going forward, do you just trim it down below? Okay.
We never had that situation so far, but that's what we will do. Because when we say that we will not let our position go beyond 30%, that's what it means.
Thank you.
Yeah.
Hi Rajeev, this is Nitin Jain. I work for Discovery Capital. We've been investors, global investors, including India, for over 2 decades. So we are relatively familiar, I can say. Question to you is more macro. I know the balance sheets, both on the private side and the government side, looks pretty pristine financial sector as well. Why do you think the capex has not taken off in India? It's been a long-lasting expectations for at least 5 years, but it doesn't seem to show up. Utilization rates are, capacity utilization rates of some measures are in mid-70s, but that's when we should see, but we haven't seen it for 5 years.
What's your answer to that? Your own question.
Still scratching my head, please.
I thought you will help me there. Okay, no, so I think why capex has not happened is, in my mind, is because there has been a little bit of this uncertainty. Like, suppose today if you do a capex and suddenly, let's say, US market is no more available. Suppose you were looking at exports. People are saying, listen, let me take a little bit more time. So my view is a little bit of the uncertainty is causing that. There was also this concern that it's not just about India exporting, but what happens to the imports that might come from other countries, right? And if China starts importing into India, pretty much many of these sectors will have a tough time unless there are enough safeguards. So I think the question is, are there enough safeguards and enough incentives for many of these companies to benefit from the growth they are seeing both in India, but even outside of India? And then the second thing that you also pointed out is capacity utilization is around 70-75%. And one would have expected that it starts here, but they still have that leeway, 75 to 80, maybe they cannot service the customers beyond 80%, right? And so it is like, okay, I can still manage the order book that I have, the orders I'm getting, the customers that I'm seeing, and so they're like, okay, I have some more time. And I think possibly that is also an explanation. And the third thing I will say is government slowed down last year, as we all know, and government was driving a lot of the whole investment in India. And as they slowed down, everybody got worried. And I think they just want to see that pick up enough and benefit or come right after that. That's my answer to you. Yeah.
Yeah, Rajeev. Thanks for hosting this.
Yeah.
A few questions I have. One is on the cognitive aspect of investing. So I asked this question on the earlier panel as well, right? How do you like generate ideas? Like you sit and like figure out, or like you read a lot. Like what's the process?
Yeah.
Or like there might not be a process, but like what do you do to kind of come up with ideas before you like get into actually analyzing the company?
So if you have done this for a while, there are more ideas. So at this point, it's not about idea generation. It is about idea filtering. There's so many ideas I have today. Generation becomes less of a problem. Now, where do ideas come from? Which is your question. So ideas could come from, I own a company X. There are 5 competitors of company X, right? Could those 5 competitors be opportunity set for you? Yes, because you understand the business already, right? You already understand the business. Who are the other competitors for company X? Why are they not in your portfolio? Are they better or worse? Why are they better or worse? Right? Prices change all the time. So all of those 5 possibly are your ideas that you can look at, right? Many times you will get ideas because I already will know many companies, many sectors in the past, but not necessarily have been owning it because right now we don't think they are valued cheaply enough, right? So what you have learned in the past creates a lot of good ideas because you know that business, that sector, and you say, okay, somebody comes out with a result and the stock falls 20%. Right? Could that be an idea for you? Absolutely. So you are always looking at what is moving in the market. And then moving in the market, does that correlate to your understanding of the business? And then that could be a source of idea. I think there are a lot of special situations that keep happening all the time in the market. That could be another source of idea. You're going to a conference like this. Here we are not talking about ideas, but there are many other conferences where you talk about ideas. That is a huge source of idea as well. So ideas actually are not a problem at this point for people like us. It is how do you quickly filter them and decide which one to focus on.
Thank you, Rajeev. The first question, is there any minimum limit to invest this fund?
Yeah, there is a minimum. Why don't we take it offline? I don't want to sound like I'm soliciting business here. But there is a minimum, yes, absolutely.
Okay, so
yes.
Second question, you said that turnaround for approximately is a 20% in last 5 years.
Yeah.
So that's anytime you sell any stocks, that's a taxable event, right?
Yes.
Even we will not withdraw any fund, but we have to report to in the federal and state tax, and we have to pay. We can get the credit from the what you pay tax in India. That's correct.
So the way the credit works is, you will basically report your capital gains and dividends that you have received. And whatever is the differential is what you have to pay. So it's not like government is giving you any money back. It's just that you're not paying to the government the entire amount.
It will offset.
It will offset, exactly.
But still you have to pay the federal tax and state tax in the US.
Yes, for whatever is the differential.
Yeah.
Yes. State tax, you don't get any credit. It's only the federal you get the credit.
Yeah.
Yeah.
Okay. And the last question, do you have any estimate or prediction about US dollar and Indian rupee currency? Generally in the last, if you look at, there is a 4% depreciation on an average.
Yeah.
What do you think about, it's just prediction.
Yeah.
So it's not, so next 5 years, 10 years, it will continue the 4% depreciation or you will expect lower than 4%?
Right. So since we started the fund, okay, so since April 21 to end of 2024, INR has depreciated annually around 3.8%. So you were right there. Okay?
Yeah.
My expectation is, see, ultimately, if you look at the currency depreciation, what is causing it, right? It is the differential in the interest rate, effectively, right? And India almost always had much higher inflation. Did I say interest rate? Inflation rate.
Yeah.
Much higher inflation rate than US. What is now happening is India's inflation is now being targeted at 4%, as we all know.
Yeah.
With a band of 2 to 6%, that's around 4%. And RBI is pretty good with that. They are pretty much strict, right? On the other hand, US used to get 2%, and you can see that it has moved up some. And I think there is a tendency of saying, it's all right, right? So I feel that the differential between India and US in in terms of the inflation rate is coming down, and therefore my expectation is that the depreciation rate will also come down from the 3 to 4% to lower than that.
Because why I'm confused last, if you remove the 3-4 weeks,
Yeah.
even the inflation was high in the US.
Yeah.
The comparison wise is not that gap, but still the Indian rupee is depreciated in last 2 years.
Yeah. So one of the things we have to realize is in the short term, what makes the market move, be it on the FX or the stock or anything else, is the demand supply. It's not the fundamentals. Okay. Ultimately, the fundamentals catch up over many years and maybe many decades. Right. So I agree with you that inflation in US was much higher, actually higher than in India, and yet rupee was depreciating. Right. And that was because of the demand supply situation where FPIs were pulling money out. So ultimately, there was a dollar that was flowing out from India. And now suddenly the mindset has changed and people are actually putting money into India. And so obviously now the rupee is appreciating. So in the short term, it's demand supply. We should not confuse that with the long term. My expectation is if we from here look out a decade out, I think one would expect that the depreciation will come down. I'm definitely expecting that. That's another tailwind.
Final and last question. Will you organize the same event next year?
I hope so. you just have to do more job of advertising about it. Okay, I think that's good. Thank you very much. Now, okay, so thank you very much.